What's up, millennials? If you're looking for a relatively safe fintech play, then I might have the SPAC for you. Today we're going to take a look at the valuation of a company called OppFi, and this is a company, a fintech company, that is going to merge with the SPAC that's currently trading as the FGNA stock. Now, before we start, if at any moment during this video you don't really know what I'm talking about, please check out my full SPAC guide that I released a few weeks ago. It's going to be somewhere in the description, and today we're going to be taking a look at method number 2. Also, if you want access to the Excel sheet I'm going to be using today, you can join our Discord for free to get it. You can just go to nesami.com/discord, then you can leave your name, leave your email address, and you're going to get access to it. And as always, don't trust me, verify me. I'm just documenting my journey here on YouTube. I'm certainly not a financial advisor. Don't copy my numbers as is, but always use your own multiples, your own numbers to come up with your own fair price per share. OppFi is a fintech platform and they are mainly focused on the lending business. They have a focus on the median customer, as they call it, with about like 50K in salary, annual salary, and who don't really have access to traditional loans. So then OppFi is the solution for them. They're also using artificial intelligence to automate their business, and they're planning, as we can see in the investor presentation, to get into the credit card business as well. The merger date, we don't have a fixed date just yet, but they do say that they expect to close the merger somewhere at the end of Q2 of this year. If we take a look at the pro forma valuation according to the investor presentation, we can see that they of course started trading at $10 per share. And there are going to be, after the merger, of course, 80.3 million shares outstanding. So that's the number that I put over here in my Excel sheet. So that means that you can already multiply these two numbers to arrive at a pro forma equity value or a pro forma market cap of $803 million. Then we can also see that they're going to have a net amount of debt on their balance sheet of 106 million. So that's the number you can plug over here. So a minus 106 million. And that is going to give you a enterprise value, a pro forma enterprise value of $909 million, okay? Just a few things here. First of all, if we go into trading view, we can see that currently pre-market they are still trading around that level of $10 per share. So right now we can see that they trade at $10.03 per share. We can of course plug that into our Excel presentation, or in our Excel sheet rather, but the numbers aren't going to change as much because yeah, a 3-cent difference doesn't really make a lot of difference. And then I'd also like to talk a little bit about a few things that are quite interesting for this company, good and bad. First of all, we don't seem to have a PIPE investment. That is quite interesting. Usually you have an additional PIPE investment around that are like private investors with quite a lot of money who bring some extra cash to the table, which is not the case in this SPAC. But we can see that the amount of, the piece of the pie that SPAC investors are going to get is relatively large compared to other SPAC deals. Usually it's around like 10-15% more or less, sometimes even 20%, but here it's even 30%. So that's quite a big difference. And then another important difference is, as we can see in the footnote, it's going to be a little bit small. I am going to zoom in a little bit, but in footnote number 4, we see that the ownership excludes the dilutive impact of, first of all, let's see, 5.6 million sponsor warrants struck at a certain price, which are not in the money just yet because the current price is around $10. Then 11.9 million public warrants, also struck at 11.50 and just 11.50, so those are not in the money yet either. And probably the biggest chunk is 25.5 million earnout shares, which are going to be earned or which are going to be released at these share prices of $12, $13, and $14. So all of these earnout shares, all of these public warrants are not in the money just yet, but do keep in mind that once the stock is going to go above like $15, then almost all the warrants, almost all the earnout shares are going to be issued, are going to be exercised, and the amount of outstanding shares is going to be higher compared to what we see right now. So we've now talked about a pro forma valuation, but what is exactly the fair valuation? What is a fair price per share? Well, first of all, to arrive at a fair price per share, we first need to determine what the fair enterprise value is. So what OppFi should actually be worth more or less. And for that, we're going to apply a certain formula. We're going to first of all take a look at the EBITDA of a certain year, in this case just 2021, so this year. And then we're going to apply a certain range of multiples to that EBITDA of 2021. So we need two numbers. First of all, EBITDA 2021, then the range of multiples. Let's first take a look at the EBITDA of 2021. And of course, these are expected numbers. We don't know for sure if this is going to happen, but we are going to just roll with these numbers from the investor presentation. So these are not my subjective decisions, my subjective opinions. Okay, so first of all, we can see that OppFi does have a proven track record. We can see that they had already revenue in 2017. They bounced it up nicely in 2018, like a 100% increase. And then it went again like 100% increase in 2019. And then it went to 323 million in 2020. So that looks pretty good. In 2021, they expect to have $418 million in revenue. And we can see that next to the EBITDA, we can see that they expect to have $132 million in EBITDA this year. So that's the number you can already plug into your Excel sheet right over here. And something else that's quite interesting about this SPAC is that OppFi is already a profitable company. We can see in the investor presentation, they already have a positive amount of net income for the last like 4 years, more or less. And we can see that in 2021, they expect to have $66 million in positive net income. If we go to the Twitter feed of the leader of this SPAC, we can also see an interesting poll, which basically says that most people think that there are 0 to 7 SPACs that have positive net income of the 85 deals, SPAC deals that still have to close. And well, OppFi is just one of these very small amount of SPACs that actually do have that net amount of income, which is positive. So that's pretty good to see. Okay, so we have that EBITDA of 2021. Now we need our range of fair multiples. How are we going to do that? Well, we are going to compare the multiples of OppFi to the companies that are in the same sector as OppFi itself. First of all, we can see in the investor presentation, their own multiple is 6.9x. Because we saw that, well, if you look at 2021, the EBITDA was 132. If we multiply that by 6.9x, we arrive at that enterprise value of $910 million. And that is the same enterprise value as we have seen in the beginning of this video. But then if we look at the other companies in the similar sector like Catapult, Sezzle, Afterpay, Repay, PayPal, Progressive Leasing, we can see that these multiples are actually a little bit higher compared to OppFi's multiple. We can see, for example, for Catapult, they have a multiple of 26.2x, Afterpay more than 50x even, Progressive Leasing a little bit higher, 10x more or less, Repay 28.9x, PayPal 42.5x. So the question to you is, what do you think is a fair range of multiples for this company, for OppFi? Personally, I've come up with a range of multiples from 20x on the low end, 30x on the high end, because quite a lot of these numbers, quite a lot of these multiples are within that range more or less. So again, if you think this range of multiples is too high or too low, you can always change it. You can just take the Excel sheet, plug in your own multiples to arrive at your own fair price per share. But let's actually roll with these numbers. So let's go to the Excel sheet, because the Excel sheet is already going to calculate the rest of the numbers for you. What it's going to do is the following. First of all, it's going to take that EBITDA of 2021, which was $132 million, and it's going to multiply that by 20 to arrive at a low enterprise value of $2.6 billion. And then it's also going to do that with the high multiple of 30x to arrive at that high enterprise value of almost $4 billion. Then it's also going to calculate a midpoint valuation, which is basically just the average between the low and the high valuation, which in this case is $3.3 billion. But that is, of course, the enterprise value, okay? We want to know what a fair price per share is going to be. Well, to arrive at a fair enterprise, or to arrive at a fair price per share rather, first we need to go back to a market cap, a fair market cap. And we do that by taking into account the amount of net cash, or in this case, the amount of net debt they have on their balance sheet. We said they are going to have $106 million in debt on their balance sheet. So if you take these enterprise values, if you subtract the amount of net cash, you're going to arrive at these fair market caps. So 2.5 billion on the low end, 3.2 midpoint valuation, 3.9 more or less for the high valuation. And then the only thing you need to do is to take those market caps, divide them by the amount of outstanding shares, which we said was going to be 80.3 million shares, and then you're going to arrive at these fair prices per share. So for the low end, $31.56. For the midpoint valuation, $39.78, and for the high valuation, $48. Now these numbers do seem a little bit high, so maybe the range of multiples is a little bit high, but it could also be that you need to take into account, again, those earnout shares, those warrants, because in total those are like 40 million shares, and if 40 million shares are going to be added to the amount of outstanding shares after the merger, and we're going to end up with like 120 million shares, the fair price per share is going to change quite a bit to like $21 to $32 more or less. Of course, keep in mind that the net amount of cash is going to be a little bit higher as well, because the company is going to be receiving money for those public warrants especially. So keep that in mind if those warrants are actually exercised in the end. So based on these calculations, it looks like OppFi is still undervalued. Of course, don't trust me, verify me, always check what I'm doing, always check if the calculations are actually correct. And also keep in mind we have been taking a look at assumptions. We've taken a look at a certain EBITDA, a certain predicted EBITDA. We don't know for sure if this is going to be the case for this year. It could be higher, it could be lower. And also keep in mind we have been taking a look at a range of multiples. Maybe that is too high, maybe that is too low. That is up to you to decide. Plus, keep in mind that share dilution that is very likely coming if the price of this company is going to be above a certain threshold. So I'd like to hear from you as well. What is your price target for OppFi this year? Let me know in the comments. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye!